Today, you're going to hear some names in the list of top 10 companies that you can invest for the long term to grow your wealth. Just a sneak peek into today's list, they include McDonald's, they include Amazon, which has fallen by 50% in share price. But not just them, another company has also fallen by 50%. This other company, surprisingly, is non-tech. So if you're curious to find out, continue watching on. Hi guys, welcome back. Without further ado, let's start with the first name on today's list, which is number 10, McDonald's, with the ticker MCD. I'm sure you've been to McDonald's, no need to introduce them a bit further, but I'd like to share with you some other things that you may not know about McDonald's. By the way, PepsiCo was 12 on our list, and Google was number 11 on our list. So if you haven't seen, check out a previous video related to this, and I'll leave links above and towards the end of this whole discussion. Now McDonald's, if you see the share price, it's been trending up consistently, correct? It's not like a multi-bagger kind of thing. Right now, price-earnings ratio stands at 33 times, which is close to an all-time high for it. Dividend yield is only 2.28%. But what is good about investing in McDonald's in a recession is that you should know that many people eat unhealthy fast food in recessions. More so actually than during normal periods. This article actually confirms on that. And I'm sure you also understand the joy when it comes to binge eating fried food when we are sad and stuff. That is normal. But again, it reinforces McDonald's is a very recession-proof business. Its food, for example, is definitely cheaper than most restaurants. If you compare McDonald's against Starbucks and Yum Brands, which owns KFC, you'll see that McDonald's share price in the last 1 year has been pretty strong. And just as a fun fact, McDonald's is globally diversified, but US still accounts to about 40% of profits. In terms of ownership, McDonald's owns about 40% of its outlets, which means also 60% is franchised. But I found something interesting or disturbing about McDonald's before you get invested into it, something that you must know. While McDonald's bonds are investment grade, if you see over here, you realize that McDonald's has actually a very high debt to equity ratio. It could be because it's been using it to buy real estate and to set up stores to expand globally, but that debt is definitely going to be a burden moving forward, especially when we move to a high interest environment. That is something I'll be monitoring a bit closer. As of now, net income still looks very strong. Hopefully some of the debt is long-term based and is not too impacted by short-term interest rate increment. So just in case you are whether I actually get such detailed information, check out our sponsor today, who is Webull. I use Webull myself, it's one of the lowest cost brokerages. And if you're looking to invest in US stocks and ETFs, check out Webull. And not just that, right now they can even allow you to buy mutual funds at $0. If you are new to the platform, simply sign up with my referral links below. Any deposit with $2,000 and a trade in a stock, ETF or mutual fund will enable you to earn this $150 worth of cash vouchers. So again, sign up today with the referral links below. With that, let's dive back to our list for today on companies that you can invest for long term to grow your wealth. And number 9 on our list is 3M with the ticker MMM. Look around your house. I'm sure there's something that you have used 3M for. For myself, I use Scotch-Brite and I use actually the command tape to hang up some of my posters. 3M's products need no further elaboration. But what you may not know is they actually make a lot of profits also from the industrial side. Their products can also be used for safety requirements in industrials, which is why I've actually ranked them so highly on our list. Just to recap again, if you haven't seen our criteria, how I actually rank this list starts from, is this company having a very good long-term track record? Has it survived war recessions before? That will give us an indication how well it will do in this current recession climate. The second is this company still founder-driven? That's why you won't see Tesla or Meta on our list, but 3M definitely is one that has a very long-term track record. If you see a dividend history, you realize it's a dividend aristocrat, which means it has consistently grown its dividends across the years. In 2017, quarterly dividends was 1.175, but right now it's $1.49 per share. That's why also, in terms of protecting your monies against inflation, investing is still the best way to protect that money because dividends can actually grow when a company runs its operations correctly. But before you get invested in 3M, there's something I need to tell you about. This is the company that has dropped more than 50% since its highs in 2018. If you look at the chart over here, horrific decline, correct? Or 52.95%. If we see in terms of the 1 year chart, you see that decline being very obvious. But if you see in terms of the long-term chart, you realize that 3M has been a multi-bagger for many investors. What is going on right now in this company? Net quarterly income looks good. Of course, there's a dip in second quarter 2022. If we look in terms of annual income, you realize that it's still pretty strong, correct? Rebounding also from COVID period. So if earnings are looking strong, why in the world is this company trending downwards in share price? Why has the price earnings ratio fallen to 10 times and dividend yield now at an all-time high of 4.9%? The very simple reason is that 3M is facing litigation risk. There are lawsuits that are pending that could cost the company billions of dollars, but of course these kind of lawsuits take many years to unravel. That's why there's an overhang in terms of the sentiment. But if we take reference from what BP has experienced, BP had actually a major oil spill in 2010, whereby it actually paid in total of fines and compensations $65 billion. BP is still around today, and looking on hindsight, it did not actually put the company out of business, and neither did it lose too much in terms of long-term shareholder value. But as always, before investing in 3M, make sure you're familiar with what could happen to this company, because that is the reason why investors have been selling out over the last few years. With that, let's move on to another company which is much more stable, just in case you don't have the stomach for too much volatility. Number 8 on today's list is P&G, Proctor Gamble, with the ticker PG. Proctor Gamble needs no further introduction. I'm sure you're using some of its products. Just as a fun fact also, fabric and home care make up about 1/3 of Procter & Gamble's revenue. So when it comes to toilet paper, no one cares whether there's recession or... In fact, what we learned from COVID is that toilet paper is precious. It's not something you would give up even if there's lockdown. So people actually stacked up on toilet papers during that period. That shows how resilient their consumer products are. P&G has a very long-term history. They are dividend aristocrat, and they've been through multiple tech crashes and global financial crisis. If you look in terms of its dividend history, you see a beautiful upward trend of it. Previously less than $1, now hovering almost $3, correct? If you look in terms of latest dividends, you realize that financial 2022, Procter & Gamble has returned $3.52 dividends per share. Wow, that is a fantastic rate of return. Again, 66 years of dividend increment. Sit on this company and you get rewarded well. That's a very simple conclusion to things. And that really reinforces the point that Warren Buffett has shared before. Nobody wants to get rich slowly. I think Procter & Gamble is one that if you can find a good share price to enter in, it's going to reward you big time. Not just them, number 7 on today's list is someone who's sound, who's definitely someone you are familiar with, and is even bigger in terms of Procter & Gamble's revenue. It is 10 times the size of number 16 on our list, which is Kimberly-Clark, which owns Scott's brand. This company owns Listerine, which I use every night, maybe you also do so, and it's none other than Johnson Johnson. Johnson Johnson goes with ticker JNJ, and Johnson Johnson carries these following products, which you have seen before. At current market cap of close to $500 million, Johnson Johnson is about the same size as Tesla already. Tesla has fallen tremendously in the last 1 year, dropping by 50%. But Johnson Johnson has eked out a 4.72% gain over the last 1 year. Right now, price earnings ratio is 24 times, which is close to its historic average, and dividend yield is 2.52%. But the beautiful part about Johnson Johnson, like Procter & Gamble, is that it's increased dividends over the last 53 years. Sit on this company and your monies will beat inflation. That's the very simple logic of things. Dividends were about $3 per share, but right now in 2022, take a guess how much have dividends climbed to. The answer is about $4.50 per share. Fantastic, correct? This can be confirmed in its quarterly dividend history, whereby it pays $1.13 right now. So coming to here, if you've learned something already, help me smash the like button and press on subscribe, especially when to follow on our list, because today I've only a chance to cover 5 names, and the top 5 is something that you should stay tuned for. So thank you so much for sticking. Let's go with number 6 on today's list. I mentioned this company in the intro. It's none other than Amazon.com with the ticker AMZN. I've covered Amazon on this channel before, and Amazon is definitely someone you are familiar with yourself also. Let me do quick introductions to it to help you understand very quickly of its business mode and business model. But before we get there, let's see the share price trend. You see that Amazon has been one of the best multi-bagger stories ever. But what we see is that the last few years, Amazon has not done too well. This is the 5-year chart and this is the 1-year chart. You see that in terms of earnings per share, it has underperformed market expectations. That's why its share price has been punished. And the key reason for that decline is because Amazon has actually dropped into losses in first quarter and second quarter of 2021. There seems to be a rebound for third quarter, and maybe there is some glimmer of hope that the worst could be over. But what has actually caused all this decline? Let's look at how Amazon actually derives its revenue and income. This quick snapshot actually shows you where Amazon pulls in its money. The black bar over there is its Amazon Retail Services. The yellow line over there is Amazon Web Services, AWS. What we can see from the bar graph is that the e-commerce revenue has been growing tremendously over the last 10 years. Not just that, cloud revenue has also been growing. And the surprising part is as of right now, cloud services, which is AWS, actually contributes 74% of total operating profits. Whereas e-commerce, although it contributes so much revenue, only derives that little in terms of net profits, which means the margins are much lower. But AWS itself has been facing some headwind. If you look at the latest third quarter statements, you realize that Amazon cloud business has also recorded weak growth, missing analyst estimates. AWS actually clocked $5.4 billion for the quarter, which was significantly less than market expectation. Not just that, AWS's margin has actually contracted, which means also the landscape in cloud services is challenging. Competition is also rising. Microsoft has been eating some of its market share. But I actually like to think that this could be an opportunity to look at Amazon a bit closer. If indeed net profit from cloud services is about $20 billion, applying a 20 times price earning, which is not excessive, AWS itself will be worth $400 billion. The key question then will be, how much is Amazon's e-commerce business actually worth? If it is worth $500 billion at least, then Amazon could be fair value or even slightly cheap as of current moment. Again, don't be spooked by share price declines. They could very well present opportunities for you if you are willing to look long term. As always, this chart is provided by our sponsor today, Weibo. So again, if you haven't signed up, look for links below to sign up today and earn some cash vouchers for yourself. And with that, I also like to pose a question to you. Which of these 5 for today's list is your personal favorite? Leave in the comment sections, justify it, and maybe the best one will get featured when we cover the number 1 to number 5 on our final list. Thank you for staying till here. As always, check out the previous videos related to this, and maybe they can inspire you further in your investment journey. If not, sign up from here. Take care as always. Goodbye.